Many of the world's central banks are now moving towards rate cuts after the belief that inflation has largely been tamed and that the current rate levels are restrictive. There are two central banks, though, that are moving in the opposite direction. In July, the Bank of Japan raised rates from 0.1% to 0.25%, which is the highest level in 15 years. Now, for the last 5 years, it's been apparent that the Bank of Japan had different challenges and goals than the rest of the world. Deflation had been a major force in the Japanese economy for decades, and it was generally accepted that BOJ would be far more tolerant of inflation in the short term to make sure that deflationary pressures were indeed gone. Therefore, the BOJ kept rates negative until March of 2024 before beginning a very casual rate hike cycle to make sure inflation never has a chance to become entrenched. In Australia, inflation persists with a current reading of 3.8%, but the Australian central bank is torn. Not only are they concerned with inflation, but also with the economic health of their trading partners, China and Japan. Perhaps that's why the RBA short-term rate sits at 4.35% despite the elevated levels of inflation. A simple strategy that currency traders had employed was to be short the currency of low-rate countries and buy the currency of higher-rate countries like the US and Australia. Of course, this strategy may not work forever as trades become crowded over time, leaving them vulnerable to any slight change in the narrative. In this case, that change could be any acceleration on Japanese rate hikes.